None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is the very last day of summer. Last time you're going to hear that Summertime Blues song, in case you didn't know what that was. Mitch and I were talking offline. This market's been as flat as it can be. Probably seen one of the best rallies of the week right in the last hour, which we'll cover here in just a few minutes. But yeah, it's pretty quiet out there for the most part, volume-wise, everything. I guess the kids are back in school, or will be, and we're supposed to get back to work. I guess that's how it works, right?
I guess.
We have to kind of give some kind of example, right? Instead of sitting around and playing golf every Friday. Anyway, for the three of you that are still in your office today, we're doing this broadcast. We got so many emails. We're out of the office today. Maybe you're watching from remote, which is all good. But there's some to cover because at the end of the month, there's some things that are going on. Absolutely zero news today, right, Mitch? I don't think anything was out at all.
Well, I mean, a couple economic releases, but really, I mean, nothing that shifted the market.
Right. Yeah. Well, something shifted it because it's rallying, but
it is rallying.
But we're pretty close. We just printed what it looks like to be the extreme for the day, and we'll get into some of the details. But one of the things that was kind of, I don't know, not irony funny, but that the fact that when the rumors of the Russian troops in Ukraine, when they were rumors, the market dropped 20 handles. Now that they are in the Ukraine, they go up. So it makes sense, right? And Europe last night, I was up kind of late watching the action in Europe, and Europe started off really strong last night, and then there was some kind of report about a high level of terror possibility in, I guess, probably London proper, and that just took the markets down, so they ended up flat. So all that enthusiasm, as it was last night, the futures were up. I think we're due to open about 700 to 800 points higher. We're now up 6, so we're getting up into the range where that was. I'll be able to show you when I bring up the 24-hour futures chart in a minute, but not a lot going on here. We're looking at the 10-year continuing to move down. All this stuff is happening. So I guess since there's not much in there, Mitch, I'll probably be using you as a research analyst here. I got a couple of things I want to cover today.
All right,
and
sounds good.
We'll go ahead and dig into the technicals here and get going. One of the things I thought was interesting here as we come into the end of the month, we see this huge rally, and right now we're hovering along the 10-period moving average. I think about 3-4 days ago, this thing was printing the PPM1 was printing to the point where it was in a pretty robust uptrend. That has now faded to the point where we're not in an uptrend anymore, and that this thing has got a pretty strong probability of dropping probably about 1 to 1.5% back into this 1980 to 1965 range. Looks like it's pretty possible. We'll see if I mentioned in commentary last night that we needed to close over 2001.95. So we'll see. We're above that right now. And I suspect that by the time we finish this broadcast, the 2 or 3 of you that are here, and including the guys under New York, will be heading out the door, maybe to tee it up or whatever, or go be with the family for the long weekend. This is our last break for a while, I guess. I've never been a fan of holidays. I know that sounds weird. I actually like what I do, so it's a little bit different when you're not doing that. But the technicals here on the S&P is really starting to fade. You can see these indicators over here on the far left, the PPMs, and while PPM 2 has crept up, it's at 0.06. We're at 0.21 on the PPM 1 and 0.02. So the 21 and 40 period moving averages are pretty flat, and those are the values there are let's see here, they are 1991.78. The extreme the support number 3 was 1991.55, so it came in line pretty much with the of the 10 period moving average. Below that is 1961, 1965. So if we get through this 1992 level in the next couple of days, we're going to head right straight to these lower averages, and depending on what happens, we could see this thing completely fade back. I'm not sure until we see a little bit more of this pattern what's happening there. But it's sort of like what we talked about. I talked about in commentary and what I discussed on Monday, is that there's not a lot here to grab onto to make this market move higher. You're really not getting anything, and there seems to be a fair amount of optimism around from the standpoint of what's going on with the world. Everything's going to work out, and it's like I don't know, what is it? Maybe it's like a Disney movie or something. In the end, everybody's smiling and they're kissing at the end. I don't know what's going to happen with all the unrest that we have in the world, whether those are things or not that are coming out that are going to cause a market to change direction. For right now, the trends as we go through here in a minute are pretty minimal from that standpoint. And just getting off screen here a minute so I can show you exactly a little more detail. If we go over to the weekly graph here, you're going to see there's one thing I need to adjust real quick. I thought I saved this page after I formatted it, because I'm going to need these values, and I am going to quickly set this value up. All I'm doing is going, so these values are going to update during the show here, so bear with me. I just realized that when I brought that up, it wasn't working. And now we should be fine. Yep, everything's there like I thought. Okay, so this pattern that we're seeing, this is the weekly pattern. If you will recall, it's faded a little bit. We're at 0.20, 0.34, if I toggle down here a little bit, 0.34 and 0.26 on PPM 3. So we're still in trend mode on 2 of the indicators, which are below the market, and we're below trend on the PPM 1. And what that's telling me is that we are seeing a little bit of fade. We're not getting that acceleration, and that is really key to understanding what's going on here. And that what that suggests is, even though we were able to print a new high, we're probably still locked in a range. And there's a cluster of numbers that come in above this market around between 2006 and 2012. So there's a lot of resistance here, and unless something exciting comes in fairly quick, we're going to have a difficult time getting through this level. So let's go through. This is the last day of the month. This is a monthly close. I talked about it, I think, twice this week on commentary. And one of the things that's important to to understand is typically when you get these big high closes, you get what is an outside bar. So we had a low of 1905, 04, and a high of 2005. So we had a 100-point range this month. Well, it seems like it was really quiet. It was pretty dramatic at points in time. We were moving up pretty steadily. And I believe in some of the stats I saw, it's one of the better Augusts that we've had for quite a few years. Typical August is the dog days, and there's not a lot going on. Well, this has been the last. As a matter of fact, the range has been bigger than the last 2 months. And if we go here, look at July's range, it was 1930 to 1991. And if we go back to June's range, we were 1915 to 1968. And those are, and this month of August, we actually had a wider range in those 2 months. So we've actually did an outside bar, but I'm not sure if there's any around, but typically when you close on a month, the last time we did this was in 07, that it looked good, and the Tooth Fairy was coming and everything was going to be wonderful, and it was like the next month just didn't start that way. We know that September and October have a tendency to be a topping type pattern that comes out during these periods of time, but we'll see when everybody gets to work, starts to dig in, see if we see a little bit more volume. That's not going to be hard because it's really low. The three-day rangefinder now is at 6.81, and I think we've exceeded that today. We're looking at about 9 points, so that's going to move up a little bit because the last 3 days have been like nothing's happened at all. So I'm glad we weren't doing these shows on Monday, Wednesday, and Friday because there'd been absolutely nothing to talk about other than maybe looking at some other stories. But the patterns themselves, 132, we're starting to see this 10 pair. Let me bring this up so you can see this. We're starting to see the PPM starting to slow down, like I've been talking about. Now at the bottom of this table that I just brought up, you see. Let's see if I got the right value here. There we go. 132 is the PPM1, 163, 104. I've been talking and harping forever about this PPM1 dropping below 1%. As soon as we get the first tick on Monday and we see the values on Monday, this value will recalculate for the month of September, and I'm going to bet that this thing is going to lose a lot of momentum. And whether it gets through 1%, I think we're within 1 month or maybe 2 of this starting to happen, which at that phase is the time when we'll start to see a monthly pattern where this thing will start to top out. Doesn't mean the sky is falling. It means that this thing is going to lose its momentum, and we're going to see the 21 and 40 period moving averages start to catch up with the action that we see here. Right now we're still in this very robust trend, and the PPM 2 and 3 are not likely to be flattening yet, so we're going to see the 21 period moving average come into the 22 to the 10, and this is the beginning signs of what a top looks like. I've been talking about this for several months, making sure those of you who watch the show all the time, you know this, but this is what happened in 07, this is what happened in 2000, this is what happens on every top. Go back to 1987, I was writing newsletters back then, and in September of 97, September 16th, I think it was, the date of the newsletter, said the risk reward of owning stocks in the United States was 0, get out. And I wasn't expecting a crash, which we had less than a month later, about a month later from that point, but I was seeing some major divergences, a lot of things that were going on from a technical standpoint that just said, if nothing else, they weren't going to go up. Well, it turned out that we had a 40% decline in 3.5 days. And that's not what I'm predicting here, but what I am saying is that this is the type of pattern it sets up, and we're going to know more literally the first tick on Monday morning. So on Monday's show, it's going to be, or I guess Tuesday, right, Mitch? I'm already on. So Tuesday's show.
Tuesday's show, yeah.
Tuesday's show, we will be covering that. And, that I'm anxious to see those numbers. That's going to be pretty significant. So, but this is the pattern that is there. This is how it always looks, and what we'll see is once we have not. If you look at this line here, I'm going to blow this up a little bit, get off screen for a second, because I think this will good to focus in on. Is that this, when I spread out this chart a little bit, and you look at this 10-period moving average, since we started the real strong part of this trend, we have been above the 10-period moving average. So I'm just going to draw a couple arrows here. So this was the pattern. Once we started this elongated move here, we have not been below this 10-month moving average. We really didn't get that close. This number is, I can't bring it up right now, but it's around 1885. That was a number we were talking about when we printed down at 1904. If it didn't hold, if it got through that 1904 level, then that was the next level. Well, it held 1904. We've rallied 100 points, and now it's like, now what? You know, so it's one of those where we dropped 100 points, almost about 85 points, and now we've rallied 100, and it's, you know, trying to find another bagman to buy it above 2,000, and we're not seeing this kind of momentum. But you can see once again this line has been a very important line since really July of 2012, and that's important to keep in mind. And this is going to be the critical line. And what we saw as I go back and expand this thing back out, when we look at back in 2007, you'll see that once we broke this line, it was the same scenario here in 05 up to 07, and once we broke through that line, we came down to the 21 period moving average, and this is this is one of the rules that was developed all the way back in 1984, that the first bounce off the 21 is typically a high. We have not had a bounce off the 21, a new high. So this tells me that we're going to see a decline down to the 21 month moving average. We'll talk about this and what the values are in a second. But then in the case of 2007, it printed a new high, and there just was nobody home. Nobody else wanted to buy this thing. It reversed, and we know what happened after that. But we also had a backdrop of a lot of financial risk that was coming into focus at that time. So it was a lot different time. Even early on in January of 08, we'd already had the Bear Stearns issue. We were starting to see a lot of mortgage issues already come into focus. It wasn't until August and September was when Lehman failed. So we saw catastrophic risk come into the market, and all the bailouts, AIG, and go down the list. That's not where we don't live there today. Those elements aren't there. Those aren't the type of things that are going on. And certainly the housing market, while it showed some pretty good numbers this week, we didn't really see, we don't have a bubble type environment in real estate. Although I was talking to somebody the other day, and they were telling me there's a couple areas here in the valley where people are going crazy to get land, and they're tearing down houses and rebuilding because it's cheaper to buy these older homes and rip them down because the land's real cheap in an area. So there's still very frugal people that are going out there and buying these things. But this line on this 10 period moving average on a monthly, that is the key line to watch, and it'll certainly be what I'll be focusing in on in September and October as we move forward.
Hey, Bob, is there any significance to how large of a spread there is right now between the different monthly moving averages? Because, looking at this chart, I see there's significant gaps between the 10, 21, and 40 on this month compared to historically. It doesn't look like we've seen such a large gap, at least in recent memory.
Actually, if you look at this chart here, right above my head, it was pretty expanded back in 2000. So this is a pretty robust trend, and This was, those of you maybe don't care, but when we were on a trading floor, I had a buddy on another floor, and we used to hold our fingers up like this. It wasn't the number 3, but it was to demonstrate. He'd ask me if we were in a trend, and this is what a trend looks like. The moving averages are spread out. This is a trend mode, and whether they're at an extreme or not, the more extreme they are, probably the stronger it is. So it doesn't mean that it's some kind of peak. It actually is an indication of strength. So from the standpoint of all the people that have been on CNBC this week and talking about 60% declines, probably not right now. There's Ralph Alcampara, which I know Ralph. He's a former Bay Area buddy of mine, and he was quoted in CNBC of saying pretty much what I when I saw that, I thought, yeah, that's pretty much agree with that. As far as a collapse going right now, there's not the case. In 1987, we had already formed a top, we had a decline, and we had the right shoulder. That wouldn't happen until just based on a regular chart. We're probably looking at maybe into November, maybe into January before we'd even set up any kind of pattern like that. So from the standpoint, we're probably going to go stagnant. We should see a move down to this 21 period moving average. So from the standpoint of what we're looking at here, let's bring up those values so we can get a couple numbers on here. And the 21 period moving average right now is 1736, and that number is rising right now at 1.63. But just to give a rate of change on this, it's about 20 hang on, it's about 20 or 30 points per month. So if it's 1936, it's going to be 1966, roughly 60, in the 60 range. As soon as we click over on Monday, that value will jump as the moving average is calculated when we get a closing value on this month. So the bottom line is that's jumping up, but that's still a pretty good decline from 2000, and that's going to be moving up over the next 3 months at that same point. So it's going to be 60, it's going to be closer to 1800. So if we did get through, we could bring up some Fibonacci relationships and some other things that we'll talk about that. And we'll talk about that when it's relevant after we see a penetration of the 10-period moving average and we start to see the PPM1 drop into values that we know that this configuration is happening. At the moment, it's not happening. It's not really relevant other than talking about what is most likely going to happen at some point. These events will happen, and it's just a matter of time. And this is what I always call the super slow-mo chart. So it takes a month to get to the next bar. So we're looking at maybe 3 to 5 months to set up any kind of pattern that's going to be significant. Meanwhile, what that means from a trending standpoint and what's been going on in the markets, we'll see how we come into September and the rest of this year. But we have seen just a lot of charts topping out. I was going through, which maybe I will do this later after we finish the indice section of this, is talking about what the actual some of the sectors. If you look at the sectors, which VPM's, all of VPM's proprietary indexes that we have on the sectors are non-weighted. They're average price of all stocks in that index. So it's kind of a price weighted more than anything else, but it's an average of all of those. And almost every one of the sectors have declined pretty substantially, and they're not making new highs. They're just like when we were talking on Monday about IJR and MDY and a lot of these indexes, and a lot of mutual funds that also have not made new highs while the S&P is making new highs. So S&P is not the I guess the key element in determining market breadth. It's a set of stocks that's well watched, but it doesn't really indicate what everything else is doing or should be doing, actually. And when you start to look at what's happening there, it is really significant that you can see the lack of breadth in this market and the lack of follow-through. So we're narrowing down. Also 2007-ish, from the standpoint, was about, actually this phenomenon started happening in around July or August of '06, and the market did rally up toward the end of '06, and then '07 was a very choppy year, and then we saw one last new high in November, and then that was it. But all of these elements started to occur as some time, and then when you're looking at the monthly chart, you can see here, I'm just bringing up a value here. It was 8307 is where we saw that was around the time that the first Bear Stearns announcement that it had problems with margin call, and it was actually a liquidity issue, as it turned out. It was initially broke that way, but the bottom line is this is where it went to the 21 and it bounced and made this new high. So we're going to see, we've got several months more of work to do before we're completing this particular trend. And I hate to say that, and this is where maybe I start to agree, I'm not necessarily going to go with a 60% decline, but when this party ends, it's going to have a pretty substantial decline. And because of the thing that Mitch brought up a minute ago and how far spread out they are, it does indicate where the significant spread numbers are. So we were just talking about the 1736 level, 1760 as of Monday, and when you look at it's 1543 for the 40, and that is only moving, if I can get this value real quick, that's moving at about 15 points a month. So it's moving, because it's a 40-month moving average. What is that? 3.5 year moving average, or how many? What is that? I guess 3 years. Close to a 3.5 year moving average. That thing's moving really slow. It's not going to go up much. So that point, one of the points that is valid is once we do see a turnaround, these moving averages you can see as in 2007 we hovered around that 40 period moving average, and ultimately when the 10 period crossed through and we started to decline sharply, that's where the real top of the acceleration of that downside happened. Typically it happened in 2000, it happened again, and I mentioned, I think 2 days ago in commentary, about the EPS ratio being around 19.1. The forward-looking EPS is interesting, at least from the source that I use. They're looking at 16.3, which suggests that the EPS ratio is going to drop about 15-20%, 13 to 15%. So I don't know what that would equate into markets, but market sentiment could certainly push it down. So this would coincide with maybe coming down to this 40-period moving average sometime next year. And everybody's excited about the 4.2 GDP number. We'll hold on to your horses, because what happens is the market is anticipated to strength. That's why the prices are here. This is all those technicians and people have talked about how the market leads about 6 months ahead of the actual economic numbers that come out. So you're seeing that markets moved up. Now we're starting to see the economy start to show a little more growth than it has, and that may not equate into higher stocks. The fact that that's going to work out. So we'll see how everything plays out. But certainly, I'm babbling on about this trend, but this trend is very much intact till we see some penetrations of the magical 10-month moving average. Which I didn't bring up that value. That value is 1886, as I suspected. So, we've got, and that number is jumping up at about, let me bring this up on screen so you can see it and make it easier for me to see it as well. That number is jumping at 20 points a month. So all of a sudden that's going to be that's going to be up at 1895, 1892 range, depending on the values that we see on Monday. So we're just using the current rate of change of 1.32. So we'll see how all that happens from there. But so it's jumping up pretty quickly. So by the time that we get, let's just walk this forward one more month, and let's say it stays at the same rate or close to it, probably be a little less, but you're going to be at 1920 plus, and that is in the range of the last 3 months low. So that's going to put us into that state where there's a likelihood of the market getting through that number. Now that's considering we're not at 21 or 2200 and it runs away, the S&P makes another runaway. Doesn't appear that's what's going to happen. Our job is just to follow through and watch what's going on, but certainly the trends are intact. So, well, I got really carried away with that one, but it's important to understand. Let's take a quick snapshot of what happened overnight. You'll see that some of the cycles that came in, there's a cycle due here in a few hours, getting closer to the close today. I suspect whatever's happening today, we're going to see this thing fade into the close. We had pretty good cycles hitting. We had a cycle here in a 5-minute graph. Let me make this full screen so you can kind of see these things. They've lined up pretty good this morning, and you've got this a cycle that came in this morning at right at 7:15 Pacific time, so that was about 45 minutes after the open. That's where the rally started, and then you see a volume spike over here on the hourly graph, where my cursor is right now, and that is where the hourly turned around, and we spiked down and we rallied right back in this pattern. And for Thursday morning's commentary, my expectation was that we would get through the extreme support on the downside, and it did do that, and we went down to 1990, and then it rallied back to close just down a few points. And as it goes, we were down 3.38 right now. Over the last 3 days, we are now, it looks like we're up 4. We're actually up like 36 cents. So nothing's happened. It feels like something's happening, but nothing's happening. We're at 2082. What we closed at 2002, 2012, and now here we are at 2000.81. So I guess we're 60 cents higher than where we've been on a closing basis. But these patterns seem to keep going on. I want to go over to the webs here, and we're seeing this thing starting to show signs of rolling over. We're getting volume rate of change spikes here so volume is more important from my viewpoint about some of the extremes. So I'm always looking for some extreme value to put a climactic note on a pattern, versus how some people think that if big volume means there's more coming. It's usually the opposite. It's usually the tail end. You get low volume, then you get a volume spike. That's usually a price point that you want to pay attention even on as a top or a bottom, depending on configuration. And right now it's pointing more to which we haven't seen much, but on a rate of change basis, we've seen it spike a little bit. So it's been pretty quiet from that standpoint. So let's go to take a quick look at some of the international spread. This is the spread I've talked about, I guess maybe too much, but this is the EFA versus the S&P versus the EFA, and you can see this spread continues to decline. I've talked about this. The market, we're not going to see a big decline in this market until this spread turns up. And what that'll tell you is that money is flowing. Right now, money is flowing into the U.S. because of what's going on in Europe and other places. If you're up late or up early, depending on where you are in the country, and you watch CNBC, Squawk Box Europe, everybody comes on, they're going to say, well, we're currently allocating to the U.S. We're currently allocating to the U.S. It's the U.S. And that's how it continues to be, and you can see it in a chart. And that's been the case. This is a chart that you're looking at right here is from 09 to current. So the S&P has been outpacing the EFA all along, and we bring up the other chart here, which is the versus the EEM, same type of situation. So when these charts turn, it doesn't mean that Europe's going up and we're going down. It just means there's going to be a deceleration. You're going to start to see money coming out of the U.S. And until that happens, we're going to see a continuing trend, or at least a good solid bid under this market. So it goes nowhere until these spreads turn around, in my opinion. we've seen some moderate turnaround. You can see back here back in the beginning of 2013, but then as we came in to 13, which was a big uptrend, this chart's going to go down. So when this thing turns down, that'll be the story there. So I continue to focus on that.
Well, I did think it was interesting that I saw a Reuters article this morning saying that overnight lending turned negative between the banks there. So they're paying to give people money within the banking system overnight, so that they don't have to have that obligation on the books.
Right. And
there, I mean, that's just crazy.
Well, yeah, it's, the 2-year German notes, I think, are minus 0.03, something ridiculous, and the Bund was printing at 0.88%. So on a 10-year piece of paper from Germany, you're getting 0.88. So you can get 2.32 or 37 here. You're buying that all day long, and that's part of the flow in the capital here. And then because 2% isn't much, people are willing to take a risk, and that's actually the low interest rate scenario that the Fed's been playing. Is don't pay them for being in cash, make them buy some other assets that will cause that to happen. So cause them to take more risk, which they've certainly done that. So the rich get richer as the market goes up, and the people that they supposedly are trying to help are still losing. So so much for all that. But all right, let's go. Oh, the VIX has increased a little bit, and I mentioned this also. I just wanted to cover some things that I've talked about in commentary, kind of filling in between the lines here, is that the VIX has now moved up to the 1218 level, but it got down to 11. See if I can get it to the right number. 1124, pretty much the lower end of where it gets to. So all of a sudden we've moved the risk meter from a lot of risk to, we got up to 17 and change. Now we're back at 12. So this meter's been moving back and forth, which suggests that we're probably at a point also that we're going to be at the top end of this range, and we're going to fall back into the range, and maybe eventually here we'll test. Like I said, we're probably 4 to 6 weeks. If we put it in week terms instead of months, when we're talking about the monthly, it's probably 4 to 6 weeks before we see a pattern falling back into this 10-period moving average, which is what going to be around the 1900 level as we come in 1895, around that level. So maybe a retest. I still think there's probably a pretty good probability of a retest of this low that we see on this chart over here. It's right by Mitch's head there, but this low is probably a pretty good point for that to go on. So yeah, let's go over real quick. I want to bring this up, and I want to bring up VPM, and these. I want to look at some of these indexes that we're flat on, and do my best to make these charts a little bit bigger here. But here's a basic material, and I just want to point out some of these, because I was going through last night just to kind of get a feel for how these sectors are unfolding. We've got all these flat sectors. Matter of fact, we own 4 of 12. I wanted to look at the ones we didn't own, even though we sold at the bottom of this thing, and it is a right shoulder. We're not seeing the acceleration that we need to see. I would have been really smart to put this in Portfolio Experts, so I could show you the PPMs with this, and I can do that, but it's going to take me too long. I just want to look at the pattern. I'm going to show you this pattern on this chart, but it's going to be the same pattern on the others. I won't draw them in, so I'll bring them up. But this is that whole elongated pattern, but this is the key right here. Couldn't find my cursor. Is this, and then we get this right shoulder. Typically you get this pattern here. You're not seeing the momentum that we normally see on this type of pattern. So this is the same expectation for a lot of these patterns. So if I go back and let's go back to research, look at consumer cyclical. You're looking at a pattern here to same pattern here. We made a high. This one's a little different, but it's similar. We're rallying back, but we're not making new highs. I'm going to go through several of these, just the ones that we're flat on, and look at some of the ones that we're not. Same thing. This one's really capital goods is hugely big decline. We got out. We've been out of that for a while. It set up and made a new high, but then failed. Once it failed, then you can see it's just coming back to moving averages. And if I did bring up this in experts, I could see the PPMs. You'd see that this is a pretty negative scenario that we have here. So it's actually in a downtrend with quite a bit of resistance. So as we go through conglomerates, same thing, exit out. This was from an exit from a trade long ago. Right shoulder, we're into declining moving averages. So I was just thumbing through a lot of these. Energy, same thing. We were long this index for a while. It got out. Now we're seeing it faltering. Matter of fact, the 10-period moving average is rolling over already. And this just goes on and on all these. Financials have a little different pattern. They have a little bias to the upside, you can see, but they're still faltering, not making a new high. And when you start to, now we go to healthcare. Healthcare is long. We've identified a trend here, and it's printing up pretty much at the highest level that it has been. And let's look at technology, since that's a big piece of the market out there. Same thing. We had a trade that was on since early 2013. We just took it off in the last few weeks, and now it's rallying back. Right shoulder, no new high. These are the kind of patterns that typically will fail and get that same zigzag pattern that I just showed you, where we get a right shoulder, then the next one will be a retest of the lows. Usually we'll go below this 40-period moving average, which is at around 40 on this index. So these are the things that I started looking at last night and realizing that of the sectors we have long, they have bias to the upsides. There is trends there. As I mentioned before, we still own SPY, which is I just went through all kinds of detail on the S&P, and that is in a firm trend. But when we go and start breaking down into different asset classes, start looking at style boxes, there's not a lot participating, which is pretty typical in this final run. You get, I think it was a couple conferences ago, I talked about the large caps would take control, and waiting for the final rally, that would be the case. And we've definitely got that going on now. We could do spreads versus S&P versus IJR, or change out to MDY and all the different, some other, just from an asset class viewpoint, and you would see the spread differentials and how the S&P is leading those. So all of this stuff is aiming at a very narrowing market breadth. That's why when we go to research here and you look, we're 43.52%. That means, and as I've talked before, not every cycle looks like 2008. We're not in a crisis mode, but what we are in is a lot of patterns have broken down. In fact, 10,365 of them have not a positive pattern that you can tag on the trend, and that's what since we are trend followers, you can't find a trend in 10,365 financial symbols. And from the database standpoint, that is typically how markets go. And maybe it stays like that for a while. Maybe we see some declines. We'll see if we can retest in 1905. Whether it happens in September or October, it certainly looks like to me that if we don't find something to move it out of this market, this momentum's just going to die right in front of our face, and we're going to see this thing start to turn around. But if we were to break down and start triggering through stocks in each one of these indexes, if we'd have spent the last 35, 40 minutes just talking about that, we would see on an individual stock basis one broken trend after another, after another, after another. So anxiety about what the market's doing and printing up where it is right now is probably not well found. So the bottom line is there are just everything's pretty much broken right now from the standpoint of a trend, but not everything is in a downtrend. Most things are in a sideways mode right now. So the next 2 months are going to be pretty significant as it turns out for these trends. So I think I've exhausted about everything that I could talk about on this, because I think it's important, even though the three of you that are watching, thank you for showing up. Hopefully the people that are streaming this will get this, but the bottom line is this is what's going on with these trends, and we're coming into probably the most critical level we've been at since, we'll just say since 2008 or 2000 or 98 was another one going back. And I believe these are significant areas of the development of these trends that are going to be needed to watch very, very closely. So Mitch, I sure hope you got something else to go on here.
Well, I just wanted to highlight some of those stocks in particular. So, I mean, I have a list of some of the stocks that are most commonly held, and I figure we could start with Johnson & Johnson. That's number 2 behind Apple right now.
Oh, really? That's interesting.
And right now in the 3.2 system, we're currently flat at. But I think that's another good example of where the trend broke down, and it has rallied a little bit, but it's still not making new highs.
Yeah, so here's the monthly. Let me get over to the weekly. And you said 3.2, correct?
Yes, sir.
Okay. So yeah, we're out of this thing now. There's been some good trades here, but from a standpoint of what's going on, this is actually pretty much what I was talking about. We're seeing the same type of pattern. Let me just draw this in so we can make sure we overstated this point. But here was the trend where we exited, but then you get a decline, you get this right shoulder, and it's going to test this line here, which is that 40 period line. And whether it goes down very much or not, it's certainly not going up. And this is the point of the 10,300 some stocks that don't have a position right now. It's because of just what I'm talking about here, is the probability of it going up is less than the probability of it going down, and that you don't want to own things during that period of time. When the patterns turn around, there'll be a point in time to own this stuff again. But for right now, you got a fair amount of cash. I suspect anywhere from 40 to 60%, in some cases a little less, on an individual stock portfolios. But on the index side, there's just more risk on a lot of these indexes on this right shoulder than there is probability of it going into a new high. So that is just the configuration. It's just a reality of where we are there. So,
hey Bob, we got a question from an advisor through the email, and they mentioned that in today's commentary you said never sell a quiet market.
Yeah.
Ann wanted to know what the rationale behind the statement was.
Gosh, I don't know. You'd have to talk to that old guy that had almost had no hair and was probably been dead for 40 years. That I heard that on Board of Trade in 1979. It was from a corn trader. So he always said never sell a quiet market. So, if we'd have been selling the last couple of days, you'd be looking at little losses. But, in this case, in the stock market, there may be a rally out here, but it was just, I don't know, when I was writing last night, it just kind of came out. So from that standpoint, it's really just an old adage that comes out. It's one of these old cliches that floated around the floor, but it was from an old corn trader. This guy probably had to be at least as old as I am now. Then.
Really old.
He is really old. So he'd been around a long time, and that was just an old statement they used to make, and there's some validity in it. Sometimes you get that, and like I said, there's still, as I just went through in the detail on this, as looking at the world as the S&P sees it, it's being driven by fewer and fewer stocks, and that's something I'm going to try to research to see if we can get how many stocks are actually showing new highs in the pattern and all of that stuff. We'll do some research. It kind of triggered some thoughts, but yeah, it's just an old adage. I don't know how much validity it is, but it has been quiet. So.
Well, right now, I mean, the average VPM portfolio is about 50% invested. So,
yeah, about right.
I mean, we're defensive certainly, but not incredibly defensive. Not in the bearish cycle like we've seen in years past.
Yeah, and those of you that we've suggested when you're building your strategies, we always suggest that you have a beta of 1.2 plus. So 50% cash is really more like 70% invested if you have that beta. And if your average beta is higher than 1.5, then you're still 75, 80%. This cash number depends on what you own with that, of the 50% you own, as far as what the beta is and what that stuff is doing. And that's probably driven more by the individual stock strategies are keeping that average up, I would suspect. We don't have a breakdown by index versus stocks, right?
Not yet. That's one of the projects that I have in the background.
So yeah, so from overall standpoint, that sounds about right. And like I said, not everything looks like 2008, where you get where everything goes to zero. In fact, the only time I've ever seen it go to zero, and all of the declines, I've had this software in some form or another in front of me since 1992. Since VPM's been around since 1997, 98, we've had a view of the database, and this is the way it always I guess sets up when we're in a corrective protective mode. That it just means what I said earlier, is that there's more probability of downside than upside. So what do? Do you continue to hold an asset? No, you get out. You're better off to hold cash at that time. Pull in the exposure. And so the whole process of VPM is changing that exposure. And on individual stock portfolios, you get much more incremental control over the exposure. And then you also, if you're looking at a 1.2, I always like to have some 2 and 3 betas in my strategy. So when those pop in, those can really, when you do get them and they get traction, you can really pump up the equity. And if you look at some of the charts that we have out there from the standpoint of the trade impact charts, you can see some of these impact on, all of a sudden you see these 5 and 6% impacts on your portfolio. Typically out of a 24 stock portfolio, you're only going to have about 4 to 8 stocks that are going to drive all of the performance in any given time. And when you see it pull back to 50, anywhere from 40 to 60% range, it's just protecting. You still have some assets that can grow. And sometimes if you have the right assets, like I said, I think I mentioned on Monday, you can still have a salmon portfolio that can swim upstream. Even though the markets are lackluster, you can actually put a portfolio together to do pretty good, depending on your screening methodology and what kind of rotation is going on within the style box. I don't know, somebody said it once, there's a bull market somewhere all the time, and there's plenty of stocks that have certainly went up if you can figure that out.
I thought it was always it's 5 o'clock. It's always 5 o'clock somewhere or something like that.
Maybe for clocks, but in markets, it's always there's a bull market somewhere. So there's 18,000 items in our database. Something's moving up somewhere. But the point from the standpoint of how we manage assets, it's about fundamentally screening and filtering through a selection process, and that selection process is going to be rotated. And we just finished. This is the month August where most of you have rescreened and started a rotation on your outliers from the standpoint of all the stocks that don't have positions. You want to refresh in the new screens, new list, the best that you can, and that's how the best way to walk it forward. So when you do get new buys off of stocks that are not long right now, they're also new fundamental stocks that have been chosen, and that helps the rotation. So when we do get in the next cycle, wherever that is, maybe the market never declines below 1850, it goes sideways and chops around for 6 months, and then there's another cycle on the upside again. I don't know how this thing plays out. It sure looks like to me on a monthly basis that we are coming into the end of this cycle, which has been a long one, over 5.5 years now. that we're going to see the end of the cycle and some corrective phase come in. It's just natural to happen, and the Federal Reserve can't do that. I talked about before how China has their state capitalism. It's pretty much how we're running this country now. Government spending and the central bank pumping money around and trying to stimulate everything. So they can't, even then, with the Chinese trying to do the best they could, they had a substantial market decline, and right now there's perceived to be a lot of risk depending on who you talk to in the Chinese market. So maybe it's China that rolls us over, and we're so busy watching the Ukraine and the Middle East, and China's really the straw that breaks the camel back. Who knows how this thing ends? But bottom line, and there doesn't have to be a crisis, doesn't have to be a 40 or 60% decline of any sort. So I always like to bring this chart up real quick. It's right in the middle of Mitch and I. It's a Dow Jones from 1925, the current. You can see where we are on the planet, and it's probably at some stages even going to go flat, but most likely this thing needs to correct at some stage. You can see we were at all the way down here at 6,000, and now we're at 17,064 on the Dow Jones. And once upon a time in 1929 we got down to 15. But these aren't the same stocks. This is a pretty manipulated index, to be honest with you. They change stocks based on what Dow Jones Irving think are going to help keep the index going up. Their goal, I think, is to keep the index going up. So anyway, but yeah, so that's just a good perspective. So back to earth here. What else did you have on there?
Another stock, it's going through a similar pattern. This one we're long is Cisco. We are long it on the 1.2 weekly system. I think this is number 3 in the database. But again, this is another stock that peaked a little while ago.
Is this 3.2 as well?
1.2.
1.2. Okay. Yeah. So to finish up the show here, I'll go through this. I'll go back and just kind of set up for the long weekend because we only have about 3 minutes to go. But this pattern here, you can see we are long this stock, and we are seeing the same kind of right shoulder pattern here. We've actually traded off. We went to the 21, so theoretically we should run back up toward the high on this thing and then fail if it doesn't get back above this 10-period moving average, which is right now 25.15. We're pretty close. If we get back above that on a closing basis, then we could move up back toward the highs around 26, around 27 and change. So that's pretty much it. So let's go ahead and just finish off the show just looking at a couple things here, and I'll get to the right chart here. Here's the futures chart. So we're seeing the 5-minute graph. Looks like if we trade down, it's going to be right at the close where the cycle comes in. So maybe that's going to be a low cycle. I'm not sure how. There's not any real good signs of it. It looks like we're probably going to go stable. I doubt if I've been watching a little bit. If we go up, matter of fact, here's a better way to look at this thing. We have seen the market drift just a little lower. This is the 1-minute graph, but I suspect this thing is going to go into a dormant phase here in the next couple hours. Everybody's leaving, heading out to the Hamptons, I guess, this weekend.
Yeah, it's already 1 o'clock East Coast in a second.
Yeah, they're trying to beat everybody out of the city so they can get out of there. I'm sure that's going to be the case just everywhere in the country. And anyway, but this is exactly what we expected today. Some upside. The number that I'm watching is 2001.95. So 2001.95. If we close above that today, we're going to be pretty much setting a somewhat of a positive tone coming into next week. And we still have to get over 2006.30, but above there's just a cluster, like I said early in the show, between 2006 2012. There's just a crazy amount of stuff there. So anyway, we've pretty much at the end of the show. We'll see you on Tuesday, and on Tuesday we'll be talking about the monthly graph and some of these momentum that's happening. So thanks again for watching, and we shall talk to you on Tuesday.